podcast. Today we are going to study about international sources of funds. In particular, we will be discussing foreign currency convertible bonds and foreign currency exchangeable bonds. This session will include currency convertible bonds, the meaning, the regulations binding on them, their broad features, their conversion into shares, their disadvantages. Foreign currency exchangeable bonds will also be discussed, their broad meaning, features, the eligibility conditions for issuing of these bonds, the use of these funds which are obtained as a result of the issuance of these types of bonds, their redemption, and then in the end we will discuss some of the key differences between foreign currency convertible bonds and foreign currency exchangeable bonds. Now, foreign currency convertible bond are like quasi debt instruments and they are issued in a currency other than the issuer's domestic currency. That is, they are listed on a foreign stock exchange. So they are listed in the currency of that country. It is a quasi debt instrument because it is a mixture between the features of debt and equity instruments, and there is an option provided to the bondholders to convert these into equity. Indian companies which have been issuing these types of bonds raise funds in several foreign currencies, and the investors receive the safety of secured payments on the bond at redemption and also interest. They can also take advantage of the price appreciation in the company's stock by buying these bonds. As a result of exchange rate changes or otherwise. Now, these types of bonds are regulated under the scheme for issue of foreign currency convertible bonds and ordinary shares through Depository Reciprocate Mechanism Scheme 1993. They, however, can be subscribed by only investors who are non-resident in foreign currency. They can be converted into ordinary shares of the issuing company, partially or wholly on the basis of any equity-related warrants attached to such bonds scheme. Interest is payable on such bonds, which is also known as the coupon rate payable on these bonds. They may be secured or unsecured. Mostly in practice, the Indian companies issue an unsecured form of foreign currency convertible bonds. They have a call and put option which gives a purchase and sell option attached to these kinds of bonds. Both the options, however, are subject to RBI guidelines. The public issue is done through reputed lead managers. Private placement is also permitted but subject to certain additional conditions. There can be times when zero coupon rate FCCBs are issued, and in this case, the holders have the option to convert them into equity because it does not have any coupon rate. So, the investors in these types of zero coupon foreign currency convertible bonds find this very attractive that they are given this option to convert it into equity. Yield on maturity normally ranges between 2 to 7%. If they are listed on stock exchanges, they increase liquidity and subscription. Credit rating is also not mandatory, but if credit rating is attached to bonds, then it attaches value, and issuance and purchase of bonds by investors become easy and more secure. Issue expenses shall not exceed 4% of the issue size at any time of these types of bonds. As I have already explained, these are convertible into the underlying shares of the issuing company within the stipulated time frame. If the bondholder opts for conversion, he will receive the shares of the issuing company and that too at a predetermined rate. The conversion price is generally at a substantial premium to the market price prevailing at the time of issue. There is an exchange rate attached with such kind of issuance of bonds as interest is payable in foreign currency. So exchange rates affect the flow of cash flows for interest payments and will increase further if the bonds are not converted into equity and are to be redeemed. Then the principal and interest both would be affected by the exchange rate. Now another popular form of obtaining funds from the foreign capital market is foreign currency exchangeable bonds. The issue of foreign currency exchangeable bonds scheme 2008 defines clearly such bonds to be expressed in foreign currency, the principal and interest in respect of which is payable also in foreign currency, issued by an issuing company and subscribed by a person who is a non-resident in foreign currency and exchangeable into equity share of another company to be called the offered company. This is to be noted that the conversion is not into the shares of the issuing company but into the shares of an offered company in any manner, either wholly or partially on the basis of any equity related warrants attached to such issuance of bonds at the time of issue. They have to be approved by the RBI before the issuance and they are regulated by the Foreign Currency Exchangeable Bond Scheme 2008 which has been issued by the Ministry of Finance, Department of Economic Affairs. The issuer of the bond is an Indian company. It is subscribed by non-resident and the bonds are exchangeable into equity shares of another company, not the issuing company but of an offered company. But however, the issuing company has to be a part of the promoter group of the offered company at the time of issuance till the time of redemption of such bonds. So these types of bonds involve two companies, the offered company and the issuing company. The issuing company is the parent company and the offered company is the operating company. So there are three parties, the issuer company, the offered company and the investor in such kind of bond issuance. The eligibility condition is that the issuing company should be a part of the promoter group of the offered company and should continue to hold the equity shares being offered at the time of issuance of foreign currency exchangeable bond till the time of its redemption. The funds obtained by the issuing company may be used for joint ventures or wholly owned subsidiaries abroad. It may also be used for importing the required equipment from abroad, or it may be invested by the issuing company in the promoter group companies. The minimum maturity of such bonds is 5 years, and the exchange option can be exercised any time before the redemption. Now let us come to the key difference between the two. In case of the foreign currency convertible bonds, it involves only one company. The shares and bonds are of the same issuing company, whereas in the case of foreign currency exchangeable bonds, there are two companies, the issuing company and the offered company. Bonds are of the parent company or the issuing company, whereas shares are of the offered company, which is a listed company in the stock exchange. Students, join for the next session.